The global growth picture continues to weaken, but with inflation pressures absent, we're seeing some really quite dramatic stimulus moves from central banks. Global growth recovered quite strongly after the financial crisis of 2008, and a lot of that recovery was related to a rebuilding of industrial inventories. That initial boost has weakened. The consumer spending picture in the developed economies is really quite lackluster, and as a result the global growth lead indicators we monitor have been rolling over. But because there's so much spare capacity and so much unemployment in particular in economies like the United States, central banks are lining up now to cut interest rates or to print money. This is the reflation stage of the investment clock cycle, and our multi-asset funds have been positioned in an overweight bonds position since the summer, which has paid off. Interestingly, we're also seeing re-emergence of interest in the riskier assets, emerging markets, commodities, the Australian dollar, on the back of US dollar weakness. And this is something we've seen on and off over the last few years. Periods of dollar weakness have resulted in a stimulus, not for the US economy, but a stimulus for the Asian economies, which tend to be linked to the US dollar. So every time America devalues its currency, which seems very likely with quantitative easing coming very soon, China devalues its currency and gets a stimulus. So at the margin within the multi-asset funds, we remain overweight bonds. We've also been adding, though, to emerging market exposure. We've been adding to UK exposure, which has good global exposures itself as a stock market. And we've been adding to exposure to currencies like the Australian dollar. At the sector level, we quite like the interest rate sensitive areas. So the consumer sector, retail has been doing very well in the US, and with extra money being printed, that interest rate sensitive sector should continue to do well. And we like the global telecom sector. It has some emerging market exposure. It also pays a very high dividend yield, which at the moment when bond yields are so low is very attractive. So overall then, growth slowing down, inflation weak, but central banks taking action and printing money. We're positioned quite defensively at the moment, but it's quite likely that the global inventory cycle will have weakened and will be ready to re-accelerate by the early part of next year. So we would expect next year to be a much more positive year for risky assets in general and equities in particular. Thank you.